Imagine you invested in a mutual fund that delivered 15% annual returns over the last 10 years. Now here's the shocking part. Thousands of investors in that very same fund earned only 8-10%. Same fund, same market, same period, completely different results. Today I'll explain exactly why this happens, and how you can avoid making the same costly mistakes that are silently stealing your wealth. Most people assume something dangerously wrong. They believe, mutual fund return equals my return. Let me be clear. Investor return is not fund return. The fund's published CAGR assumes you stayed invested throughout, no panic selling, no timing attempts, no emotional decisions. But real investors? They invest late, redeem early, stop SIPs, switch funds, and chase past performance. And that's exactly where the money disappears. Let me show you how this plays out with a typical Indian fund. Year 1, fund is up 30%. Year 2, is up 22%. News channels go wild quoting, best performing large cap fund. Thousands of investors pile in. Then year 3, fund is down 15%. Investors panic and redeem everything. The fund recovers 25% the next year, but those investors already excited. They missed the recovery. Final result, fund CAGR, 15%, investor CAGR, 8%. The fund wasn't the problem. Your behavior was. Mistake number 1. Chasing past returns. People buy last year's top-performing fund, instead of a solid long-term fund. Here's the hard truth, yesterday's winner often becomes tomorrow's average performer. Buying last year's best fund is like buying a ticket to a cricket match after the match is over. The game is done. The winning sixes have already been hit. The crowd is leaving, yet you're paying full price for a ticket to an empty stadium. That's exactly what you do when you invest based on last year's returns. Mistake number 2. The classic buy high, sell low cycle. Markets rise leads to greed takes over, which then leads to you invest more. Markets crash leads to fear takes over, which then leads to you sell everything. This is the exact opposite of what creates wealth. You are buying when prices are expensive and selling when they're cheap. That's not investing. That's donating your money to the market. Mistake number 3. Stopping your SIP when the market crashes. Market drops 30%. What do most investors do? They stop their SIPs. But that's exactly when you should be buying more units cheaply. Example, 10,000 rupees SIP with NAV 100 rupees buys 100 units. Market crashes, NAV drops to 50 rupees. Your same 10,000 rupees now buys 200 units. Double the units for the same money. Long-term investors celebrate crashes. Short-term investors fear them. Which one are you? Mistake number 4. Switching funds too often. Every year it's the same. This fund isn't performing. Switch. 6 months later, switch again. Next year, another switch. Compounding requires time and patience. Every switch resets your journey. You lock in losses, pay exit load, and miss the recovery. Constant switching doesn't optimize returns, instead, it destroys them. Mistake number 5. Trying to time the market. I'll invest after elections. I'll wait for a correction. I'll wait for the US recession to end. I'll wait for the war to end. Sound familiar? Here's the problem. Markets move before the news becomes obvious. By the time you're sure it's safe, the market has already priced in the recovery. Nobody, and I mean nobody, consistently predicts markets. Time in the market beats timing the market, every single time. Mistake number 6. Ignoring asset allocation. Most investors blame their funds, but the real culprit is usually the mix. Take a 100% equity portfolio. If market falls 35%, you can't sleep, you sell at the bottom, locking in losses. Now take a 70% equity and 30% debt portfolio. The same fall hurts, but you stay invested, recover, and end with better returns. Your behavior matters more than your fund's returns. Period. Now let's look at the data. Because this isn't just theory. Morningstar's annual Mind the Gap study found that over the decade ending 2024, the average dollar invested in mutual funds earned 7.0% per year, while the funds themselves delivered 8.2%. That 1.2 percentage point gap means investors missed out on about 15% of their funds' returns. In India, the gap is even wider. Value research found that in value-oriented funds the gap was 3.21% annually, in multi-cap funds, 2.75%, even in large-cap funds it was 1.56%. Over a decade, that compounds into lakhs and crores of lost wealth. Dalbar, a respected research firm, found something even more startling. In 2024, while the S&P 500 returned 25.02%, the average equity investor earned just 16.54%, that is an 848 basis point gap, the second largest in the past decade. And here's the kicker. Withdrawals from equity funds happened in every quarter of 2024, with the largest outflows just before a major rally. Investors got spooked by headlines, sold at the worst time, and missed the recovery. This isn't bad luck, it's bad behavior, repeated year after year. Let me make this easy to understand with a simple example. Suppose you invest 10,000 rupees every month through an SIP. If you stay disciplined and earn, say, 12% per year, after 20 years your money could grow to about 1 crore rupees. But if you make just one common mistake, like stopping your SIP during a crash or switching funds too often, your actual return might drop to only 9% per year. That small 3% difference reduces your final corpus to about 67 lakh rupees, that's 33 lakh rupees less, almost one-third of your wealth. Gone just because of emotional decisions. Now imagine if your SIP were 50,000 rupees a month. The loss would be over 1.5 crore rupees. That's the real cost of behavior, and it's completely avoidable. This brings me to something that could change everything. Advisor Alpha. Vanguard, one of the world's largest investment firms, spent decades researching what actually creates value. Their conclusion? A skilled financial advisor can add up to 3% in net annual returns. But here's the fascinating part, this alpha doesn't come from picking better stocks or timing the market. It comes from behavioral coaching, proper asset allocation, and disciplined rebalancing. In other words, the advisor's real value isn't stock selection, it's keeping you from making mistakes. The single largest component of Advisor Alpha is behavioral coaching. Vanguard estimates that behavioral coaching alone can add about 1.5% annually to a client's net returns. Some researchers put the number even higher, up to 2% per year. Think about that. Just having someone to talk you out of panic selling, to remind you of your long-term plan during market crashes, to stop you from chasing last year's winners, that alone could double your effective returns over time. That's not financial advice, that's behavioral insurance. The data is compelling. Vanguard's research shows that advisors who follow the Advisor's Alpha framework can add about 3% in net returns for their clients. And investors recognize this value. A Vanguard survey found that 94% of investors said working with an advisor improved their portfolio returns, adding a perceived average of 6.5% in additional annual returns. Now, the actual number may vary, but the principle is clear: professional guidance, delivered consistently, creates measurable, meaningful value. So how exactly does an advisor prevent the behavior gap? First, they create a plan before emotions take over. A written investment policy that defines your risk tolerance, goals, and strategy. Second, they provide context during crises. A 10% correction happens in most calendar years. A 20% bear market arrives every 3 to 4 years. Seen on a long-term chart, these are speed bumps on an upward highway. But to the unaided human brain, each drop feels like an emergency. An advisor's job is to be the calm voice that says, "Remember, we planned for this. This is why we stay the course." Let me give you a powerful real-world example from our own market. During the COVID crash in March 2020, the Nifty 50 fell about 35% in just a month. Many Indian investors fled to cash. But those who stuck with a disciplined 60:40 equity debt mix saw their portfolios climb back within 5 months and finish the year in positive territory. Here's the math: a 1 crore rupees balanced portfolio that stayed fully invested from January 2020 through December 2022 ended above 1.15 crore rupees. The same portfolio that sold near the bottom and re-entered a month later ended below 1 crore rupees. The difference, over 15 lakh rupees in less than 3 years, came entirely from behavior, not from fund selection. Now let me ask you a question that might make you uncomfortable. Have you over-diversified your mutual fund portfolio? Many investors think holding 15, 20, or even 30 funds means more safety. But research shows that holding 6 to 8 well-chosen mutual funds across different categories, large cap, mid cap, small cap, and a debt fund, can effectively diversify your risk. Beyond that, you're not reducing risk, you are diluting returns. Each additional fund adds complexity, increases costs, and makes it harder for any single good performer to move the needle. If your capital is spread too thin, even a stellar fund has only a marginal impact on your overall portfolio. Warren Buffett put it perfectly: diversification is protection against ignorance. It makes little sense if you know what you're doing. A focused portfolio of high-quality mutual funds, held for the long term, consistently outperforms a scattered collection of mediocrity. The question isn't, how many funds should I have? It's, do I have the right funds for my goals? Most investors have 15, 20, even 30 different mutual funds. Each one adds complexity, increases expense ratios, and dilutes returns. The wealthiest investors I know? They have 4 to 6 carefully chosen funds. And they rarely touch them. So what do successful investors actually do? 1. They continue their SIPs through thick and thin. 2. They rebalance annually. 3. They ignore daily news and market noise. 4. They stay invested through market cycles. 5. They don't compare their portfolio to others. 6. They invest according to their goals, not according to market sentiment. 7. They review their portfolio yearly, not daily. This isn't complicated, but it's incredibly difficult to do alone, because your brain is wired to panic, chase, and fear. That's why even the most intelligent investors seek guidance. Your mutual fund is not your biggest risk. You are. The biggest difference between successful investors and unsuccessful ones isn't intelligence, education, or even the funds they choose, it's behavior. The market rewards patience, not prediction. It rewards discipline, not drama. It rewards staying the course, not chasing the next hot thing. Stay invested. Control your emotions. Let compounding do its job. And if you can't do that alone, if your emotions keep getting in the way, get someone who can help you stay on track. If this video changed the way you think about investing, I'd love for you to subscribe. On this channel, we don't chase quick returns, we engineer long-term financial freedom using practical strategies backed by data and experience. And here's something I want to offer you, a free, no-obligation portfolio review session. We'll look at your current investments, identify any behavioral gaps, check for over-diversification, and see if you are truly on track for your goals. No pressure, no sales pitch, just an honest assessment from someone who's been where you are. And I'd love to know in the comments, have you ever sold an investment because of fear, only to watch it recover later? Your story might help someone else avoid the same mistake. Remember, the difference between a 15% fund and an 8% investor isn't the fund, it's you. The 1 crore rupees mistake most investors make is letting their emotions override their strategy. Don't be that investor. Stay disciplined, stay invested, and if you need help staying on track, reach out. Your future self will thank you. See you in the next video.